Okay, in today's video we're going to take on a pretty vital topic, inflation. Now we're going to have a look quickly at what inflation actually is and how it's measured. This isn't intended to be an economics degree, so we'll just take a quick look at some of the key influences on inflation. We'll have a look at how it's measured, and we'll take a look at the impact it can have on your wealth and some relatively straightforward ways of trying to combat it. If you don't combat inflation, you are going to lose money over time faster than you might realise. So, what is inflation? Now, you can write an entire economics paper on this, but let's summarise it down to the basics. There are four factors, if you like, that influence inflation. Essentially, you can group them into two. You can say, well, there are goods and services that people want. And then there's what they need to pay for them, money. We don't run a barter economy in the UK. You don't normally just swap one good for another, a haircut for a bit of electricity fixing in your house or something. So money is obviously the mechanism by which we pay for goods and services. And in a nutshell, what would tend to push inflation up? Well, you can break it into four factors. You can say, well, for example, if the demand for goods and services rises and companies can't meet that demand quickly enough, you're going to have competition, and that's going to tend to move prices up. You can also look at it from another perspective, which is perhaps the supply drops. For example, in a recession, companies will tend to destock, as it's called, cut back. They don't want to hold too much old stock that might not sell. If the economy then suddenly swings upwards, you can have a sort of double whammy effect, because companies are going to scramble to increase the supply of goods and services. So on the goods and services side, rising demand and falling supply are fairly key influences on inflation, or can be. And on the money side, an increase in the supply can have an influence on inflation. We've seen some of this going on recently. The more money there is, money is just like another commodity, if you like, chasing a limited pool of goods and services. Basically, the more likely it is the price of those goods and services will rise. And of course, central banks have been busy printing money and increasing the supply, and some people lay that squarely at the door of rising commodity prices and so on around the world. So the money supply has an impact. Or looking at the other side, again, indicative potentially, is the demand for money falling. Now, of the four, that's perhaps the most conceptual. Keynes wrote a lot of stuff on this, which I'm not going to go into in this video, but essentially, why do people hold money, cash and bank deposits, if you like? And the answer tends to be to pay for stuff, transactional, everyday living costs, as a safety measure in case you get fired and need some cash in the bank, and for speculative purposes. And this is the idea that if asset prices are falling, I'll hold money, reckoning I can take advantage by buying stuff cheap. So, if I'm not holding speculative money, perhaps that suggests prices are rising. So, four factors, all of which, if you like, feed into this idea of inflation. Now, today we're not going to talk much about money supply. And some people out there may object to that. We're going to focus on this side, goods and services. And we're going to say, right, how do you measure the change in goods and services? And the answer is there are two commonly used measures, and we'll have a look at those in a moment. So, apologies to people who'd like to spend some time over here. This video is going to focus over this side. How do we measure what's going on this side, rather than how do we measure the money supply? And also, what should you do about it as an investor? Should you just ignore it? No. Okay, so how do we measure what's happening over here? And the answer is there are potentially quite a few ways you could do it, but you'll find journalists quoting two normally. So in terms of measuring, you've got the retail price index, or RPI, and you've got the Consumer Prices Index, or CPI. And usually this is a little bit higher than that. Why two measures? Good question. The answer is they capture different things. This is the one that the Bank of England is supposed to keep under control, and some would say not doing a fabulous job of that at the moment. This is the one they're meant to look at when they choose an interest rate, and this one is the one that a lot of people feel is more relevant to them. This is the one that is quite often used in wage negotiations, and this one includes some things that one doesn't. Now, without going into the nitty-gritty detail, both of these essentially are indices built on a basket of commonly used and consumed items, 650. Not everything that you could ever possibly consume in the UK, that would take forever to put together, but items, imagine a theoretical shopping basket if you like, chuck 650 items in, not quite the same items in both cases, and then look at what's happening to the price of the basket over time, and put an index together that reflects the rise and fall in the value of that basket. And obviously certain things sometimes come in and out of the basket because people's spending habits change. So for example, meat, dairy products, shoes and so on are fairly constant members of the basket, but what do you do when people suddenly start wanting Pokemon cards? Do you put them in for a while, then take them out again, on the basis they're commonly consumed one year, not the next? Well, that's not our problem, if you like. The Office of National Statistics has got to deal with that one. But essentially the point is these are theoretical baskets, if you like, of goods and services consumed in the UK, and they're the basis for two indices. Now the difference, crudely speaking, but it matters, is property costs. It's not the only difference, but it's a key difference. So the retail price index, why is it a bit higher at the moment? And it's usually higher, and the answer is largely down to property costs. So for example, the RPI includes mortgage interest payments, the CPI doesn't. This one over here includes council tax. That one doesn't. This one over here includes buildings insurance. That one doesn't. And this one includes house depreciation. That one doesn't. That's not the only four differences, but those are fairly key. And basically, because these can be sizable, they explain a chunk of the difference between the RPI and the CPI. Now, why does this matter? Well, when you're asking yourself, how do I protect my portfolio against inflation? You need to sort of think about, well, which inflation rate are you trying to protect against? And in day-to-day cost of living terms, a lot of people, myself included, would say that this one is the one you need to keep an eye on, even though that one is the one the Bank of England tends to look at to set interest rates. Why? Well, one argument says if you put mortgage interest costs in there, which you don't, and the Bank of England is tasked with choosing an interest rate that keeps inflation at a certain level, or so 2% level, let's say, by putting mortgage interest costs in there, as soon as you change the central bank interest rate, you potentially change the item in that basket. So you've got a kind of self-fulfilling economic prophecy, if you like. So you need to take mortgage interest costs out of there, otherwise the basket is distorted by the very decision that's taken by the Bank of England when it meets to set interest rates. Anyway, be that as it may, property costs are a significant part of a lot of people's net salary. It eats up quite a lot of that salary potentially. So the RPI, many people feel, is the better, more comprehensive measure. Now, why do you need to care about inflation? And the answer is very simple. It chews up your money over time. Here's the reason why you shouldn't just say, well, it's only 4 or 5%, who cares? Got bigger numbers to worry about than that. Well, you need to care. And here's the reason. Couple of ways you can see this. First of all, how do you get a decent return on your investments? Think of it this way. With inflation of only 5%, let's say RPI inflation, it's not exactly that at the moment, of 5%, over 10 years, £1,000 is reduced in buying power terms to just over £600. Right, in other words, 5% inflation over 10 years can seriously eat into the value of money. Why is that happening? Well, essentially because if you've got £1,000 now and you're not earning a rate that keeps pace with inflation, you are losing 5% of it every year. And that's a problem. Over 1 year, you might say it doesn't sound like it's too bad, but over 10 years compounded, you have got a problem. And as I say, if you don't do something about inflation, potentially your wealth is being eroded in quite a subtle way. I say subtle because you may not even realise it's happening. And here's the problem. You say, well, okay, so what I need to do then is invest my capital, my £1,000 now, to earn 5%. But that's not so easy. I mean, essentially, how are you going to do that? Not easy. Because, don't forget about tax. As a higher rate taxpayer, I need to earn a gross return of more like 8.33% just to break even. And that's quite a challenge. In other words, what I'm saying is knock tax off your return, because don't forget interest income and so on is taxed, it's subject to income tax, and suddenly you've got a problem. Where can you earn 8.33% gross before tax a year, bearing in mind that all that does is keep you up with inflation, it doesn't really beat inflation. So, inflation is becoming a problem, and as an investor, you need to ask the question, what can I do about it? And there are no easy solutions, but here are some suggestions. Okay. Now, whether you think inflation is a big problem depends a little bit on your perspective. As an investor, you've got to find a way to beat inflation, or at least keep up with it. As a borrower, on the other hand, you might think, well, I can sit back. I mean, inflation is going to erode the real value of my mortgage, of my personal loans. 5% inflation is going to just eat away at the amount I owe in real terms. So why don't I just sit back or even borrow some more? That would be a silly thing to do. As a borrower, best advice is to pay down some debt while interest rates are low. Otherwise, you're going to get a nasty repayment shock when interest rates and inflation start rising. So basically, if you can afford to pay off debt, overpay a bit on the mortgage, get rid of some of those personal loans, now is not a bad time to think about doing that before you get caught by rising inflation and rising interest rates. Okay, so borrowers need to not sit back too much. They need to think about how they're going to deal with debt. Investors, the objective is to try and earn a return that at least keeps pace with inflation. Now that's not easy to do. Here are some suggestions. A good bet, if the National Savings and Investment Bank introduce them again, is NSI index-linked certificates. Now, there haven't been any new issues of these recently, but these are designed basically to pay you an interest rate, normally the RPI, the Retail Price Index, plus an uplift, say 1.1%. Unfortunately, there haven't been many new issues. You do need to lock in for 3 or 5 years, but if you do, the income return is tax-free and you get your money back at the end of the period. So keep an eye out for those. If the government do basically ask the NSI to release some more of these things, those are possibly the best bet. Beyond that, other options. You could look at blue chip shares. Quite a few of these will pay a decent dividend yield, and if you wrap them up in an ISA, then that dividend yield is tax-free beyond the first 10%, which unfortunately you can no longer get back thanks to changes made by Gordon Brown. Bear in mind your capital is at risk here. It isn't there because shares go down as well as up. But that's option number 2, blue chip shares ideally within some sort of ISA wrapper. Number 3, you could take a look at retail bonds. These are corporate bonds issued by the likes of the Tesco's, the HSBCs, and there are some reasonable deals around. The John Lewis Partnership bond offered 6.5% fixed. for the life of the bond, and you get the capital invested back at the end, insofar as if you subscribed, paying say £1,000, provided John Lewis doesn't go bust over the life of the bond, you get £1,000 back. So those are not a bad option. There is default risk, the issuer could run into trouble, but that's another option, and there are bonds out there paying up to 7.5% before tax at the moment. And finally, gold. A useful hedge against the fact that central banks are busy printing money, devaluing currencies, and gold can therefore offer an inflation hedge. So what we've looked at is basically three things in this video. Number one, what is inflation? What are the factors that contribute to it? Number two, how's it measured? And what is the best measure in terms of assessing the impact on your wealth? And thirdly, we've tried to take a look at some options for both investors who've got to try and keep up with inflation and borrowers who don't want to get caught out by it further down the line.